Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hi, everybody, and welcome to another episode of the Finovate podcast. We are continuing our conversations with the FinovateFall Best of Show winners from this year's event. And joining me today, we have Stephen Reider, president of Bancography. Thank you so much for joining me, Stephen.
Thank you. Good morning. Good to be with you.
So, as you've heard me say over the last couple of weeks, you can check out all the videos from FinovateFall at finovate.com/videos. But Stephen, for people who haven't had a chance to see your video yet, can you start with just a quick introduction of yourself and what Bancography is all about?
Yes, absolutely. I'm Stephen Reider, and as Greg mentioned, I founded the company Bancography back in 2001 under the premise that banks and credit unions of all sizes should have access to top-tier tools for branch planning and marketing research. I had spent my career at a large bank called AmSouth that has now morphed into Regions Bank, one of the 10 largest banks in the country. Had the luxury of managing a department of 5 or 6 people that help the bank figure out where to open and close branches, evaluate merger candidates and such. But smaller community banks, they don't have the luxury of that. So we launched the company, my colleague Kimberly Clay and I, around the premise of affordable branch planning for institutions of all sizes throughout the industry. We deliver that through both consulting services and our Bancography Plan software tool that you saw us demo at Finovate last month.
Yeah, and it really is a cool demo, and I would encourage anybody to go and take a look at it. Now, I think we should start by getting right to the elephant in the room, because a lot of people in the fintech space, certainly at FinovateFall, were likely surprised to see a solution that focuses on physical branches coming away with a Best of Show award at a fintech conference. Can you talk about why it's so important for banks to be focusing on physical branches when so much of banking is moving into other channels?
Yeah, absolutely. And it's important to understand that even as these other channels emerge, we've never actually had channel replacement in the history of banking. Right? The ATM did not replace the branch. The call center did not replace the ATM. The online channel didn't replace the call center. The mobile didn't replace the online. Every time we've given the consumer one more channel with which to access the bank, they've simply said, hey, thanks, I'll take that too. And they've never really been willing to forego anything. And so just as we need to invest in these alternate channels, we still need to maintain the branch. Else you find yourself on the wrong side of what I'd call the and, right? If one bank has world-class electronic channels and a 24-hour call center and online account opening, period, and another bank has world-class electronic channels and online account opening and bank branches, why wouldn't the consumer choose the latter? Even someone who doesn't necessarily believe they're ever going to have need for branch, well, just in case, yeah, I might as well choose the one, right? These two are equal. I might as well choose the one that has branches too. I'd also keep in mind that we have to distinguish between the transaction event and the account opening event, right? So many electronic channels are focused on transactions, and sure enough, we're seeing transactions occur in other channels, but nobody can use peer-to-peer payment. Nobody can use direct deposit. Nobody can use remote deposit capture. Nobody can use online bill pay until they first do what? Open an account. And where they open the account, particularly smaller community banks and credit unions, those institutions, upwards of 90% of new account opens still occur in that branch channel. The Federal Reserve Board every 3 years conducts their survey of consumer finances, and it's the nation's broadest study of how American households bank, how they save and borrow and invest. One of the questions they ask is, what's the most important determinant? What was the most important determinant in your choice of primary checking providers? 42% of respondents as recent as 2022, the last iteration of that survey, still said convenience of locations. It's the most important reason behind where they chose their checking account. And in fact, the next most important reason was fees. And if you probe a bit deeper and say, oh, you chose fees, not convenience? Yeah, well, did you call all 4,500 banks in the US and all 4,000 and some credit unions and ask who had the lowest fees? No, of course not. If these 6 branches down the street from my house, I called those 6. And so even those secondary factors are seen through a filter of location. And finally, I'd point out that the branch creates awareness, right? It may seem obvious, but you can't use a bank until you know it exists. And the way we find out about a lot of retailers, where we go to dinner tonight, right? Where you do your shopping is simply by what you walk by, what you drive by in the course of your daily life. So that billboard presence from the branch remains important. Look, you don't have to ask me. Ask PNC, Huntington, Chase, Bank of America, Fifth Third. They're a small subset of the large national banks that have announced investments of hundreds of millions of dollars in their branch network because they understand that consumers, and particularly some of the more profitable consumer segments, small businesses, affluent seniors, still remain quite branch dependent.
Yeah, and I think when you think about it in that context, you start to get a sense of, again, how important that physical location actually is, how much, of the decisions that we make as human beings are dictated by what we see in our day-to-day lives. So certainly I can go onto Google, I can look at maps. When I'm in a different city, I always will go in and search what are the restaurants that are nearby, what's really well. In my hometown, I don't do that. I look at who's opening a new restaurant. Oh, there's a new sign I saw over there. So I think this is one of those really crucial things where if you only live inside the fintech bubble, you can forget the importance of the real world to some extent. And clearly the real world has a major factor here. Now, I want to talk a little bit more about Bancography specifically and the work that you do for people who haven't seen the demo, because obviously having these locations is important. What we haven't really talked about is how you get them into the right place. And that's really where Bancography can come in and play a major role. Can you talk a little bit about how you're able to help make sure that those branches go into areas where they will be the most effective?
Yeah, absolutely. And keep in mind, in reaching branch planning decisions, in many cases, the bad decision that good data can steer you away from is as valuable and important as the good decision that you actually reach. And I mentioned this, you'll recall, in the opening sentences of the demo at Finovate, the median cost of a new branch in the US is $2.5 million. And branches are fixed, right? Once you put it down, you can't pick it up and move it. If the bank makes the wrong personnel decision, you can back away from that as easily as you call that officer into the conference room with your director of human resources and you slide the little envelope across the table. It's as if that bad decision never happened. But you put a branch in the wrong place, you're going to live with that decision for 10, 20, 30 years. This is not Monopoly. They're not, houses and hotels that we can just pick up and move around the board. So it's really important to predicate branch planning decisions on sound underlying demographic and competitive and financial data. And Bancography plan addresses each of those key components in terms of first helping determine what the appropriate trade area is that a branch would draw from based on the underlying population density, providing those key demographic variables. What's the rate of household growth? Median household income, median age, percent of homeowners versus renters, business composition, right? Is this more of a residential market where bedroom suburb, everybody leaves, goes to work during the day? Is it more of a business banking market? And of course, bankers want to align market demographics with their bank's target market segments. Right? If we specialize in affluent consumers, that indicates a certain demographic profile. If we are more mass market oriented, that's a different bank demographic profile. If we're a business banking specialist, that's yet another banking profile. So we provide that demographic information that helps size the market, right? What's the size of what's the total demand? Then you want to layer in the supply side, right? To say, how many competitors are here? Market that has $1 billion in demand and 20 competitors is a very different implication than a market that has $1 billion in demand and only 6 competitors. And what types? Because some community banks, for example, want to avoid a market that is credit union dominant. They feel it puts too much upward pressure on rates. Other community banks like to go into a market that is dominated by your major national banks. They feel they can outperform on service over a B of A, a Citi, a Wells Fargo, for example. And so Bancography plan, first we start with the demographic size, the demand, then the competitive side, the supply. But finally, I tell you that if you're not driving to a full pro forma balance sheet and income statement, your decision's really just going on vibes. And that's not good enough. And that's why in Bancography plan, we take that next step that combines the demand side and the supply side to yield a full balance sheet projection. Then, as you saw during the demo, the ability to layer in your specific costs for the prospective branch, right? Land, construction, rent, personnel, rates and spreads on your products, so that you can yield those key indicators that you can bring to your CEO and CFO, so that they can render a informed decision, right? Return on assets, return on liabilities, efficiency ratio, internal rate of return, years to break even, years to positive operating earnings, and so on.
Yeah, and I think we've all had enough of the kind of executives who pride themselves on their instincts and their gut. No, when I have a big decision to make, I just listen to my gut. It's never steered me wrong. And you think, well, maybe you'd rather look at some data. Maybe that would actually be really helpful here. So, and that's exactly, of course, what Bancography can provide. Now, one question that I have is, how different is your process from what banks are currently doing? And maybe another one is, are there indicators that you're looking at that most banks right now aren't able to look at? Where does this information come from, and how are you able to use it when banks currently aren't able to use it?
Yeah, and let me back up for just a moment there, because in fairness to the gut instinct, we're not dismissing the importance of the qualitative. In fact, that's one of the reasons why, as you saw in the demo, we can actually drive all the way down with the interface to Google Maps to see the surrounding area, because the qualitative matters. Right? And we often say nobody goes to the branch to go to the branch. They go to the branch on the way to going somewhere else. And so you want to be near that Target. You want to be near that Safeway, that Kroger, that Publix, that Giant, depending on what region of the country you're in, to draw clients to your branch location. And so the qualitative is important. It's not the whole story. We want to marry it with the quantitative as well. And then to your follow-up question, in my banker days, way back when, we would go into one drawer for demographic information, one drawer for competitive information, and there was no real effective projection of demand. That was just kind of a wing it. So what Bancography plan does is a couple of things. One is it consolidates all the data sources you need into a nice, amazingly user-friendly package. So easy, even a CEO could figure out how to use it. And it also, through the segment-based demand model, translates the demographics into that forecast of market demand and then attainable balances for the branch. Look, there's plenty of sources of demographics. The Census Bureau has a tremendously robust website. You can cobble together competitive data from the FDIC and the NCUA websites, although there's a lot of inaccuracies there that we address by doing a lot of manual scrubbing and verification of that data. But ultimately, not only are we putting all of these data sources into one place, but again, this underlying demand model that translates the demographics into market demand, that we then multiply by the penetration assumption that's a function of the number of competitors in the trade area to drive to that full pro forma balance sheet, allow you to layer in the cost side that then produces the pro forma income statement such that the bank can render, or credit union can render a decision, not just against other branch projects, but against any other capital project pending. Right? If you're the person in charge of branching and you come to the CEO and say, hey, I want $2.5 million for a new branch, she's evaluating that not just in the context of other branch requests, but in the context of, oh, wait a minute, we want $2 million to implement this new sales management program. We want $2 million to upgrade the online banking platform, right? All the other capital demands that should have their own business cases and IRRs and break-even scenarios.
Yeah, and I think this is one of those really important things to remember when you think about those executives making those decisions. You're absolutely right. They have to make these calls weighing a lot of really diverse requests for funding against each other and trying to figure out where's the best opportunity. We are approaching the end of our time, and I want to end by kind of coming back up to a high level and going to a more conceptual question. Obviously a lot of noise has been made recently about how many branches have been closed. But hearing you speak about it, clearly it's a vital role for a lot of banks to make sure they're thinking about this space and doing a lot of good work here. Would you say that we are approaching, having the quote unquote right number of branches in the United States, or do you expect to see branch numbers continue to shift as we look for the right balance?
Yeah, I think that's a neat question, because too often we presume that trends, that trend lines stay constant, that rates of change don't change. But in fact, it's starting to look like we're reaching an equilibrium in branches, right? So in the early part of the 2000s, we were net adding 2,000, 3,000 branches a year up until 2009, the financial crisis. When the financial crisis hit, banks pared back openings, and from about 2009 through to 2019, we were losing about 1,000 branches a year on net in the industry. During the two big COVID years, 2020, 2021, each saw a net decline of about 3,000 branches in the industry. But then in 2023, the net decline was only 1,500. In most recent year, the FDIC reporting year ended June 30, 2024, the net decline was only 1,000 branches. In each of the past 5 years, we've seen between 1,000 and 1,100 new branch opens. The variable hasn't been the pace of opens, it's been the pace of closures. And there were so many closures in 2020, 20, and 2021 that we saw the big net declines. That number of closures, as the banks that have merged have gotten rid of those overlaps, as they've gotten rid of the lowest performing, basically the easy close decisions are finished. It does seem like we're approaching an equilibrium. And again, I'll mention a lot of large banks are investing significantly in branch additions, not to the exclusion of those online channels, but as a complement to the online channels, to really give the consumer and the small business a holistic choice about where and how they wish to interact with their financial institution.
Yeah, I think for me, it comes back to the statement you made at the very beginning. I'll have that too. I'll like that as well. It's not an either or, it's an addition to. And so, I want to thank you for taking the time to connect with me again here today. Again, would encourage anybody listening to go take a look at the demo, check out what Bancography has done, and you'll have a real sense of why Stephen was able to create this resonance within the Finovate audience and walk away with the Best of Show award. So congratulations again on that, Stephen. And thank you again for joining me.
Thank you. I enjoyed the conversation.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@Finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.